These are wealth cycles. If you have two asset classes that are rising, you have, for instance, let's say that this is real estate on the bottom, and on the top here we've got precious metals. Precious metals in this last decade here, precious metals outperformed real estate and stocks, but everything went up. Stocks went up, bonds went up, real estate went up, and so did commodities and precious metals. Is that possible? Can everything go up? Think about it for a minute. You've only got so much stuff in society, and if you've got these three or four asset classes, and everybody rushes toward one, pushing it into a bubble, shouldn't it be drawing currency away from the others? Shouldn't the others be going down? Well, they didn't in the last decade. And what's happening here, if you've got two things that are going up, if you're invested in this one down here, when you go to sell, you can't buy as much of this one. If you're invested in this one, when you sell, you can buy more of this one. They are both rising in price. This one is falling in value. When you sell it, you can't buy as much gold or food or oil. Your house is worth half as much in oil as it was. Oil was $10 a barrel in 1999. So your house measured in oil has crashed. The stock market measured in oil has crashed. If you start looking at your home or all of your investments and you divide them by something else, you measure them in the price of a bushel of wheat, a pound of copper, a ton of iron, shares of the Dow or ounces of gold, you're going to discover something. These two things that are going up, eventually the people that are invested in this one realize that the smart investors realize that that's going into a bubble. They sell and they buy the undervalued asset. And then this trend reverses. It can't go on forever. If it did, if gold outperformed real estate forever, there would come a day where 1 ounce of gold would buy the entire planet, and we all know that that can't happen, right? So eventually one becomes overvalued and the other one becomes undervalued, and the cycle reverses. And then it reverses again. And what is happening is they're printing currency at about this rate, and that's the reason you can't see it. People will say, well, at least my house is worth $100,000 more than it was in the year 2000, or it's worth 20% more. Well, if inflation was 40%, it actually went down in value. They'll say that, they look at the stock market, and the Dow right now is just barely above its 2000 high. It's a lost decade. Stocks have gone sideways for a decade, and we've had inflation during that time. They inflated the currency supply. So, if you start measuring one thing with another thing, so you're measuring stuff against stuff instead of using currency, what you discover is that everything is trapped in this valuation channel, where it goes from overvalued to undervalued to overvalued to undervalued again. And the thing that you're measuring it with is doing the exact opposite mirrored wave. The trick is, sell the overvalued asset near a peak if you can, find the undervalued asset, and I call this wealth cycles. And if you can do that, it's a road to true wealth. You're escaping that valuation channel. So here is a real example. This is the Dow measured in points. And what are points? Points are derived by the dollar value of the underlying stocks. So basically, its points are dollars. And one of the reasons that they measure it in points is just like if you go to Las Vegas, they take your currency and they give you chips. And now it's just pieces of plastic, so you don't care. You're just having fun. So change it to points, and it's not as bad as if, well, we lost so many dollars. It went down so many points. But anyway, that's the Dow measured in points. But if you go every month during this entire graph from the year 1900 to today, and each day you take the points on the Dow and divide it by the price of gold, you get how many ounces of gold one share of the Dow is worth. And this is what it looks like measured in gold. It's not going anywhere. It's got a mean of about 4 ounces of gold, which means that the price of gold should be 1/4 the points of the Dow, and then things are sort of in equilibrium. It's fair value when the Dow is only 4 times the price of gold. But what you see here is that it goes from fair value into a bubble, 18 ounces of gold, crashes down to 2 ounces, another bubble, 28 ounces of gold, because the bubble was bigger, because they print more currency in the meantime. When it crashed, it went down to 1 ounce of gold. There was a day in 1980 where gold was 850 and the Dow was at 850 points. 1 ounce of gold bought the Dow. Conversely, if you cash out, you could only buy 1 ounce of gold with the proceeds of your stocks. And then we go into the biggest bubble in history. There is no time in history, this point in 1999, 2000, there is no time that gold was as unloved and ignored as in that time period. It was no nation's money. It had gone down for 20 years. It was the worst investment you could possibly make. Nobody wanted it. Take this. This is the price of the Dow measured in gold. Flip it upside down and you've got the price of gold measured in the Dow. Put these two things together and what you find is that there's a cycle here. And if you had ridden stocks up to 1929 and then sold your stocks and bought gold, and then in 1932 gone to gold, and then back to stocks, I mean, and then in 1980 go back into gold and so on. This is a road to true wealth. I mean, you're making massive gains here. I show two hypothetical families in my book, and one goes from $35 to $11,000 over that time period, and the other one goes from $35 to $11 million. And that is the difference. One family creates a dynasty, the other one didn't even break even. This is the best way of measuring the value of a stock. And I'm sorry if I'm going fast and this isn't sinking in. I got a lot of stuff here and I got to cover it. Only got 20 minutes left. And I got to show you that the world's stock markets and real estate bubbles have to continue crashing because all it is the market trying to seek fair value. It's trying to seek equilibrium. This is what the markets do. It is their job. The S&P 500, these are PE ratios. How many here know what a PE ratio is? Okay, how many do not? It's okay to raise your hand and say that you don't. Okay, it's the price of a share of stock divided by the earnings of the company. So it's basically how much is this stock costing me compared to how much is the company making. And it's one of the best ways. The entire industry, the stock market, the industry, the financial industry agrees that this is probably the best way of measuring the true value of a stock, whether it's overpriced or underpriced when you're buying it. The S&P only goes back to the year 1950, but Professor Robert Shiller of Yale University reconstructed the S&P. He took the 500 largest companies in America and he took it all the way back to the year 1880. So you have 120 years or 121 years of data here. Fair value is when PE ratios that are about 12, meaning you're paying 12 times the earnings of the stock. So if you buy a stock, it's going to take you 12, if nothing else changes and the company continues making the same amount every year, it's going to take you 12 years to make your money back and be in profit. Undervalued is anything under 10, overvalued is 15 to 18, and anything over 18 is a bubble. And so here's the data going back to the year 1880, and what you see here is that there is no time in history that we go from fair value to overvalued. Once it hits overvalued, it does not stop. It bounces on the way down, and it visits undervalued, overvalued, undervalued, overvalued, undervalued, overvalued, undervalued. The greatest bubble in history, the year 2000, PEs of almost 45. Absolutely insane. Investing in a stock and having to wait 45 years to be in profit. This was nuts. And people were chasing stocks like crazy. This was the tech boom and so on. Well, it crashed down to fair value during the market crash of 2008, and it bounced back into a bubble. We're at PEs of like 23, 24 right now. The stock markets seek equilibrium. They seek fair value over the years. This is their job. That is what they do. There's a famous trader named Bernard Baruch who said, in the short term, the stock market is a voting machine. It's like a stock machine. It's, a slot machine, or a voting machine. It does what the public thinks it should do. The public chases after something and goes into a bubble. But in the long term, it's a weighing machine. It balances. It's scales balancing each other. That's what the stock market is always trying to do, seek fair value. It's only there for brief moments in history. But the point is that every time we are in a bubble, it visits severely undervalued, and the greater the bubble, usually the greater you overshoot fair value. This is the second best way of measuring a stock's value, and dividend yield. If you buy a stock for $1 and that company pays you 6 cents every year into your brokerage account, you're getting a 6% yield. I have inverted this chart because the higher the yield, the more undervalued a stock is. The lower the yield, the more overvalued it is. So I inverted it so that bubbles are up and undervalued is down. So fair value is 4.5 to almost 6. So there you see the same pattern as before. But here's what's alarming, is that there is no time in the first 118 years of data that we have been in a bubble this large.